6 years is the ideal time frame in which India is positioned, and no better data than what this data, right? So this is a 39-year data of BSE Sensex. It gives you a very good idea about what returns are possible in the long term. If you have to look at India's GDP for the long term grew by 13%, the markets delivered 13.4. But if you have to look at the last 10 years, GDP grew 10.25, right? The nominal GDP actually growing slower. The market is also rewarding only closer to it. So in the long term, we clearly see our return expectation should anchor to nominal GDP, and our nominal GDP is expected to be between 10 to 11. So in 11 to 12 will be a fair outcome in a long period of a time. And obviously, this is a broad market, right? So if you have to choose a good flexi cap, they can do a little better. A curated flexi cap with a PMS style can do a little more better. A PMS funds can do a little more better. So I think definitely the returns can be improved, but the base return expectation should be between 10 to 12%. So broadly, if we can double between 6 to 7 years, I think it's a fantastic phase. We need to understand today our FD returns are close to 6 to 7%, right? Given that construct, if we are able to double instead of 13 years in an FD or 12 years in FD, we can double in the markets close to 6 to 7 years. That's a right way to think about it from a long term. Obviously, in 1 to 2 years, the markets can go ahead of us, so markets can deliver a lot more return and then can consolidate. But if you are thinking about 5 to 10 years, around 12% is a fair way to think, and that's what the history suggests. The last before question, where are we in the earnings cycle? We clearly see earnings cycle is going to improve. That's why as FPS Assets, we are far more confident. Next 2 years is going to be little more better from the price action vis-a-vis it, right? So this is our 9 quadrant matrix. We really like the matrix in a way. It gives you an idea. 24, 25, 25, 26. The quality of the balance sheet was good. Earnings growth momentum was very low, right? We had an earnings growth of close to 5%. But if you have to look at 26, 27 and 27, 28, the quality of balance sheet continued to be high, but the growth is improving from 5 to 6 to 13 to 15%. So we clearly see the earnings is coming. That is where next to 2 to 3 years, it's going to be a little more positive market than a last 2 years market. The last question, what has changed, right? Definitely two things has changed. Our market has become a lot more cheaper than 18 months back. If you have to look at a very interesting metric which Morgan Stanley has put out other day, if you have to compare Sensex in gold ounce, this is the cheapest level in last 34 years, right? So if you have to look at this is the high, this is low. Now, if you have to look at, this is a week back data. If you have to convert the entire Sensex in gold terms, the cheapest at this point in time, right? So what it tells you, if you have to choose between allocating money between markets to gold, maybe the risk to reward today better in the market than the gold. So obviously, these are very long-term data, doesn't support next 3 months. But I think this gives you a very good idea which segment of the market is cheap and which segment of the market is not cheap. The second important metric is price to book. Clearly, today we are trading at lower end of the price to book after the consolidation. And if you see before COVID, the market was 12,000. Today we are 24. In a 6-year window, we have just doubled. So I think our market is not a very expensive market, but neither a very cheap market. So it's actually a neutral market where we steadily allocate capital rather than allocating either aggressively or not allocating, right? And if you have to look at our performance vis-a-vis our peers, which could be the entire MS here, it's one of the lowest point, clearly reflecting the deep pain point of underweight. Huge FIS selling is already reflected. I think what we clearly see in next 2 years, a lot of this catch-up can happen as our execution improves. And that is what, as an investor, right? If patience is something which you can give it to your portfolio with the right mentor to anchor you and have a very good portfolio, right? Maybe next to 2 to 3 years, there is a very decent chance to make far better money than what last 2 to 3 years. The last thing, growth initiative done by policymakers. We have seen rate cut, liquidity. We had seen tax cut and GST cut. NBFC credit growth is picking up. Government capex is picking up. I think a lot of growth efforts being done. And we have seen this very consistent, even the last RBI policy where the rates kept constant and they're leaning towards more to growth because we clearly see we need better growth. And hopefully with oil at 90 or maybe if it has to drift far lower to an 80, right? The risk of inflation will go down. Possibly an El Nino risk is there, which we have to monitor. But I think current policy structure is growth positive. So as an investor, right, that should be what should give you a lot of excitement on a 3 to 4 year outlook. To end, the last thing, economic cycle is good or okay. Earning cycle is okay at this point in time, will get better. Moderate your portfolio risk. We clearly see if you are overexposed to individual stock or overexposed to a lot of micro caps, got butchered, this is the time to review it, get some expert consent, review it, position your portfolio for the future focus, and actually enjoy the benefits of the economic recovery. Volatile market gives you very good time to build future focused portfolio. So I always encourage investor to see the portfolio, how it can perform in the future instead of thinking about, oh, it has fallen now, let me recover in the same place. Not necessarily. The fourth important point, sales driver will be the biggest driver of value. We clearly see with inflation coming up, sales will pick up in a lot of corporates, which is going to be long-term positive from an equity market standpoint. In the end, we clearly see risk to reward is far more favorable in large cap. That's why we giving a lot more mandates to flexi cap, which typically invests between 70% into large cap, and a very selective exposure to small and micro cap, primarily one or two funds on a specific way or a PMS, right? So we clearly see next few months is going to be a very good window if you restructure well, position it well, with corporate earnings coming right in the next 40-45 days, lot of commentary. I'm sure as an investor, we'll benefit in the medium term. Happy investing and thanks for all your time.